Good morning, all. I hope you all remember what we discussed in our previous two classes. In our first class, we were discussing what is a financial system and what are its components. A financial system is anything that facilitates circulation of funds within the economy. Now, we saw that the financial system has four main components, the first one being financial markets. So, what is a financial market? That is what we discussed in our second class. A financial market is any place which facilitates creation and exchange of financial assets. It is the place where buying and selling of financial assets takes place. We know that this financial market need not be a physical market, it could be an online market also. So, any place where financial assets are exchanged can be termed as a financial market. So, coming to the second component of financial system, the second one is financial assets, also known as financial instruments. So, let's see what are financial assets or instruments. A financial asset is one which is used for production or for further creation of assets. See, if you're buying an asset with the intention of using it for further production, for example, if you're buying some raw materials, let's assume you bought some cotton. Your intention is to convert it into a cotton sari. Okay, so you're converting that raw material into another product with the intention of selling it to someone else. So if you're using the product that you bought for further production, then it can be termed as a financial asset. Or you're using a particular asset for further creation of assets. You're purchasing different parts of a machinery, combining together and making a new machinery. Then again, you're engaging in the activity of production. Okay, so then also the parts that you bought will be considered as financial assets because you're planning to produce something out of that. Now, there is also another category, that is financial assets that give you some sort of an income in future, can be termed as financial asset. That is, if you have an asset and from that asset, if you are going to earn some sort of an income in future, then it can be termed as a financial asset. For example, you invested some money in the bank. Now, it is going to give you returns in the form of interest at a regular basis. You can consider that money as a financial asset, the money which you deposited in the bank, or you invested in a post office savings bank. There also, at a regular interval, you will be earning a interest. So then again, that amount that you invested can be termed as a financial asset. Now, suppose you are someone who like to take a little bit more risk. You decide to invest in the share market. You decide to purchase some shares. If you purchase shares, the return that you earn from shares is known as dividend. So the shares that you have in your hand will also be considered as a financial asset because it is giving you an income in the form of dividend at a regular interval. Sometimes you might have a house which you want to let out to someone. You're giving it for rent. You get a monthly rent. The rent that you earn is an income. So that house will now be considered as a financial asset because it is earning you an income. So financial assets can be of two categories. The first one is when you use something to produce something else, then that asset that you bought to produce something else will be considered as a financial asset. Or if you already have an asset which you're using to create further income or to produce further income, then that asset will also be considered as a financial assets. Financial assets could earn you income in the form of interest, dividend, rent, etc. The income that you get from your financial asset can be in different forms. I said if you're investing in some bank, then you'll get interest. If you're investing in shares, you'll get dividend. If you're investing in debentures, you'll get interest. If you're investing in a house that you plan to let out or rent out, then your income will be in the form of rent. Now, assets are also in the form of physical assets. What are physical assets? Physical assets that are most of the time used for immediate consumption. The purpose for which you are using an asset will decide whether that asset is a financial asset or a physical asset. I'll make it more clear. For example, you have a house. You built that house and you're planning to stay there. You're going to live there with your family. Then that is a physical asset because you're using that house for your own personal use and you're not generating any income out of it. Then it will be considered as a physical asset. Now, if you are going to let out that house, you are going to give it for rent, then you're generating an income out of your asset, which is your house. So if you're going to rent out your house, then that house will be considered as a financial asset. So the same property that you have could be termed as a physical asset or a financial asset, depending upon for what reason you're using it. Another example, you bought a car. You're going to use it for your own personal use. Then it will be considered as a physical asset. If you're using that car to give as high basis, like you're using it as a taxi, you're going to let people use it on a rental basis. In that cases, you're going to generate an income out of that asset, which is your car. Then it will be considered as a financial asset. So the purpose for which you are using an asset will determine whether it is a physical asset or a financial asset. If you're using it for personal use, if you're not planning to create any further income out of it, then it will be a physical asset. If you're using that asset for further production of your, or if you're generating some sort of income out of an asset, then it will be considered as a financial asset. Moving on to the next slide. Okay, now we'll be discussing the classification of financial assets. Financial assets can be mainly classified into two: marketable assets and non-marketable assets. So what are marketable assets? From the term itself, we can understand that marketable assets are those assets which can be easily marketed, which can be easily transferred from one person to another. Those assets which can be handed over to others without much formalities is termed as a marketable assets. We can sell these assets without much obstacles. So what are the different types of marketable assets? The first one is shares. You know what is a share? A share is a share in the share capital of a company. That is, if your company needs funds and you're going to start a new company, you need funds and a huge amount is required, then you will divide your capital into small parts. You know what is a capital? A capital is the initial amount that you need to start your business, the lump sum amount that you need to start your business. Now you might want to raise it from the share market, then you will divide your capital into small parts. Each part is known as a share. So you will be offering shares of rupees 100 or rupees 1000 or according to the demand of your product. You will be issuing shares in the share market. Shares can be equity shares or preference shares. And I hope you're already familiar with what is an equity share and preference share. Equity shares are ownership shares. That is, those people who purchase equity shares will be considered as owners of the company. And there's another category called preference shares. These preference shareholders have preferential rights. They enjoy two rights over the equity shareholders. What are the two rights of a preference shareholder? That is, this preference shareholder will be given preference at the time of winding up of the company. That is, if you're shutting down your company, you're winding up your company, then at that time, you will get back the amount that you invested in the business, and you will also be given interest rate at regular intervals. So, sorry, if you're investing in shares, the return is called dividend. So, you'll be given dividend at regular intervals. If you're a preference shareholder, then you will get preference over an equity shareholder. That is, the company will first settle the money of the preference shareholder and then only pay the equity shareholder. So, they will be given preference over the equity shareholders. They will be given interest, and the money that they invested will be returned when the company is winding up. But in case of an equity shareholder, they will get back the money that they invested in the business only after settling all other debts. That is, if you have taken loan from the bank, if you have creditors, if you have debenture holders, if you have preference shareholders, the company will have to settle all these outsiders before they settle the debt with the equity shareholders. So there is a equity shares and preference shares. These are also financial assets, examples of financial assets. Now, the second category is government securities. Another name of government securities is gilt-edged securities. I said these are securities which bear 0% risk. It is risk-free security because it is a government which assures the investor that they will return back the amount after a certain period of time, and that they will be giving an interest at regular periods. So the government securities is a safe investing area. Those who wish to be free from risk, or those who are not interested in bearing any risk and at the same time they want a regular income, if that is the case, then government security is a good option. So the second type of marketable asset is government securities. Third one is debentures and bonds. What are debentures? Debentures are a promissory notes that is given by the company to the person who has invested money in the company. That is, they are assuring the debenture holder that they will return back the capital amount collected from the debenture holder after a fixed period of time, and till that time interest will be paid at regular intervals. So the promise that contains all these facts is known as debenture. It is in the form of a certificate or a document. It is a promissory note, and it promises that they will return the capital amount which has been borrowed, and also that they will pay interest at regular intervals. So what is the difference between debentures and shares? A company will have to pay the debenture holder without any fail. That is, they cannot make any default in the payment to debenture holders. The interest that they pay to the debenture holders has to be made whether the company has profit or not. But in case of shares, if the company is not having enough profits to give dividend, then they can choose not to give dividend, or they can postpone the payment of dividend to the next financial year. That is a major difference between shares and debentures. So a debenture holder is more safe than a shareholder, because debenture holders will get a return even if there is no profit. But in case of a shareholder, they will get return only if there is profit. Now, the fourth category is mutual fund units, MF. So mutual funds means you will be collecting funds from different investors. Small amounts will be collected from a lot of people. They will bring it together and then it will create a huge amount. So we call it as pooling together of funds, POOLING. If you're pooling together the funds from different people, then that amount that you generated by pooling together the funds will be invested in the securities of a good company, or it will be lent out to some company which is has showing high growth potential, and the interest that you get from it, or the returns that you earn from it, will be divided among the people who contributed the funds to all the investors. So mutual funds are agencies that pool together the funds of different investors and invest in highly growth potential securities and give back a return to those who invested. So these are all marketable assets. It is called marketable assets because if you buy a share, you want to sell it, it is possible. You could just go to the stock exchange website and you could give a sell order and it is easy to sell those shares. That it means the shares which you held today can be sold to someone else today itself and it is transferred quite easily without much complications. Government securities also you can freely transfer to someone else. Debentures also, if you contact the company, then you can sell the debentures or change the name of the debentures to someone else's name. Mutual fund units are also easily marketable assets. It has got a secondary market where you can sell these units. You could, most of the time, there is a buyback option by the mutual fund agencies where you can sell the units that you bought to the company from where you purchased it. So these are all marketable assets. Now coming to the second category, non-marketable assets. These are assets which are not freely or easily transferable. First one is bank deposits. We all know that bank deposits are open in our own name, and there are different types of bank accounts. That could be a savings bank account, or a current account, or a fixed account. Now, savings bank account means there are not much restrictions with regard to the withdrawals that you can make from that account. Current account, savings bank account will have some restrictions on the number of withdrawals that you can make in a month. Now, there is current account. This is the account which is maintained by businessmen, and there are lesser restrictions in handling these accounts. Third one is fixed deposit account, where you deposit the amount for a fixed period of time, and during that period, you cannot withdraw cash from the account. Comparatively, fixed deposit account gives more interest rate than the other two types of accounts. So if you have deposits in the bank, then that will be considered as a financial asset. But these bank deposits are not easily transferable to anyone else. You can transfer the money, but the account that you have cannot be changed to another person's account easily. It will require a lot of procedures. The second one is provident fund or pension. Provident funds and pensions, you can join in a provident fund or a pension fund and set aside a certain amount at regular intervals so that you will get it as a huge amount after a fixed period of time. After retirement or when you require it after 10 years, you can collect that amount. So provident funds and pension funds are usually held in a single person's name and you cannot easily transfer it to anyone else. Now there are LIC schemes. You are purchasing an LIC policy. You can have a nominee, but you cannot change the name of the nominee without following a lot of procedures, or you cannot change your LIC policy and give it to someone else. It is not freely transferable. That is why these schemes are considered as non-marketable financial assets. Now there are post office certificates. You are investing in a post office savings bank, you will get a certificate that is known as post office certificate. These accounts can be started by even a child who has turned 10 years old. You need only a minimum amount to invest in a post office savings bank. That is, you can start an account even with rupees 50. The minimum balance that you need to have in your account is 50 if there is no check facility. And if you have check facility, if you're starting a type of account in which you want check facility, then the minimum balance that you need to have in your account is rupees 500. Usually you get an interest rate of 4% for investing in a post office savings bank. Now these are also not freely transferable. That is why it's classified under the non-marketable assets. So financial assets is the second component of the financial system. Financial assets are those assets which are used for further production, or you're consuming that asset with the intention of producing something else, or you are generating some sort of income out of the assets that you have, then it is considered as a financial asset. If you are purchasing something with the intention of personal use or immediate consumption, then it is considered as a physical asset. Financial assets are classified into marketable assets and non-marketable assets. Marketable assets are shares, government securities, debentures, and mutual fund units. Shares are again classified into equity shares and preference shares. Government securities are also known as gilt-edged securities. Debentures are promissory notes given by companies promising that they will return back the amount that they borrowed after a fixed period of time. Until that period, they will be giving an interest at regular intervals. Then there are mutual funds, which pool together the funds of different investors and invest in profitable ventures, and they will be giving back a interest at regular intervals to the people who contributed the money. There are non-marketable assets, and under that we have bank deposits, provident funds and pension funds, LIC schemes, post office certificates. So this is with regard to the financial assets, which are the second component of financial system. We'll discuss what is a financial intermediary or financial instrument in the next class. That is the third component of financial system. Thank you.